Hi there, this is Dr. Sami Garas, and in this video, we will continue our discussion about the audit evidence. If you remember in the previous video, I was sharing with you the key types of evidence under different types of internal control. And I said, if we have a good internal control system, usually the auditor runs 4 different tests, like first one is the inquiry, inspection, observation, and reperformance. And here we trust the system, so we don't spend much time on the evidence, and we are happy with the 4 different tests of controls. If we don't trust the system, then we have to make extra work and dig down in the information by making substantive procedures. So for example, we examine the assets, we recalculate all the transactions, we confirm the accounts from the customers or suppliers, and we make some analytical procedures. So let us take each one of those tests and explain it in more details. What do we mean by inquiry? It means we ask the executive management to give us some information, either in writing or oral, and here we get it in reply to our questions. So the inquiry has to be initiated by the auditor and replied by the management. It's not confirmed 100%. We don't trust the inquiry test by itself. It has to be supported by other tests like inspection or recalculation or reperformance. So inquiry and reply is a good test, but by itself is not reliable. We have to corroborate it by another evidence. Inspection, and here we inspect the document. So we inspect all the documents, the records, to substantiate the information in the financial statements. So we pick the fixed assets amount, and we go through the fixed assets record to inspect that the information about fixed assets in the financial statements are correct. And here we call it audit trail or 2 audit tests, where we take the information from the source document and trail it to the financial statements. So we take a sample from the sales order, check the authorization for the order, the shipping of the order, the issuance of the invoice, and then the recording in the financial statements. When we go this way, we call it's a completeness test, where we check that the test has been recorded in the financial statements completely. If we take a sample from the financial statements amount, and we check that there are some invoices for those clients, and it was shipped, and there is authorization and a sales order, if we go the opposite way, we call it occurrence or existence test. And here we check that the amounts in the accounts receivable record is actually happened, existed, and here is the sales order for that. So we have inquiry and inspection. Then observation, and observation comes to the operation of the client. So we watch the operation or the procedures on a daily work. So observation, where the auditor here stands still and watch all the operations and how it works. Reperformance, we test the client accounting procedures and control. So here, remember, we run those 4 tests when we trust the internal control. So for the test of control, we make those easy, short time test of controls. But if we don't trust the control, then we run substantive procedures, such as examining the fixed assets of the client. We call it physical examination, or recalculate all the transactions, or send confirmation to the clients or to the supplier and get confirmation from them, because we don't trust the accounts receivable or accounts payable of the client. And here we cover all the areas of the balance sheet, whether assets or liability or equity or other confirmation. So for example, for the confirmation of the cash, we get it from the bank. For the confirmation of the marketable securities, we get it from the custodian. For the confirmation of the accounts receivable, we get it from the customers, and so on. You can tell for each item in assets, liabilities, and equity can have a confirmation from an external provider away from the client. When we get the confirmation from those stakeholders, it's more reliable and it gives us confidence in the amounts that have been recorded by the client. The purpose of the analytical procedure, and this is the fourth one in the substantive tests, first of all, it will help the auditor to understand the industry. It will assess the going concern of the client. It means the client will be able to survive one more year or not. It will indicate the presence of possible misstatement, if there is a misstatement, and it will provide evidence for the account balance. The analytical procedures here, it involves different relationships. For example, items of financial data from last year with a year of audit. So here we analyze both years, or compare the financial information deriving from different time periods. So here we make like trend analysis over 5 years, or we compare financial with non-financial data. Why do we do that? We need to identify inconsistency that might happen between the period. And this will help us to predict the pattern or the significant fluctuations in the numbers, and we will be able to identify any fraudulent act that might happen. The analytical procedures are more comprehensive and they really provide good results more than the other tests. The analytical procedures will cover trend analysis and ratio analysis. And here for the ratio analysis, I will show you an example later on in my coming videos, that here we try to check the trend that might happen over several years to see if the current year is following the trend or is facing a spike up or down, to see if the financial information of the year is matching with the cycle of the operation of the client. And then we make common size analysis, common size where we relate the items in the financial statements to the sales and the amounts in the balance sheet to the assets. And then we'll compare 2 years only to see how the current year is compared to the last year. And then we make reasonable tests, and the application here of the analytical procedure, it will help the auditor to develop expectation, determine acceptable difference from expectations, compare the account balance with expectations, investigate the significant difference, and we can do it throughout all the stages of the audit, whether at the beginning or during the work or at the end. So this is in brief what we mean by the different types of evidence that we can collect, whether when we trust the control or there is absence of control. When we make the audit evidence, whether inquiry or inspection or recalculation or performance, we have to evaluate the cost. I am sure when you hear me in my videos talking about the audit evidence, you might come up with questions. Why don't we do substantive procedures all the time and get some reliable results? You need to remember that if the auditor is running substantive procedures, the bill of the audit fees, it will be high, and the auditor might lose his client because of the extra fees that he's charging for the audit procedures. So we need to calculate the cost and make a balance in our audit. The least expensive evidence is the inquiry, because here we ask and we get the answer from the management, which has short of time and least amount of labor. So when I ask the CEO about the sales and I get his answer, the CEO didn't spend much time to give me an answer, and I didn't spend much time with him. So my time and the management time is very limited, and the information we collect also is very limited. So it's very cheap. Also, observation. When I observe the operation, it's also very cheap, and recalculation. The moderate items are inspection, because here we have to take all the documents, spend it, so we have more labor time. Analytical procedures, when we get all the information, build up our model on Excel or any other software to try to analyze this year with other prior years. So it takes time and cost. Reperformance, where we recalculate all the information that has been mentioned, it takes more labor hour. The most expensive one for the auditor, when he goes into the operation and try to check physically the fixed assets or send confirmation to the different stakeholders that I mentioned in my previous slide, whether we send confirmation to the bank or to the customer or to the accounts payable. So here it will show us that the audit evidence might cost the auditor and the client some time, which will reflect on the audit fees. So here, with that in mind, we need to match the cost of the evidence with the reliability. So here, inspection of tangible assets, reperformance and recalculation has the highest reliability. So yes, it is costly, but it also gives me good confidence in the client evidence. The inspection of records, document confirmation, and analytical procedures, it's in the middle. Observation and inquiry has the lowest reliability level. I hope you find this video useful, and I will continue talking about the evidence and give you examples in the coming videos. Thank you so much. Bye-bye.